Hello, fellow compounders. Welcome back. Today we're diving into the world of dividend stocks, one of the most popular investment strategies. Dividend stocks are known for providing a steady stream of income. But how do you find the ones that offer reliability and growth potential? That's exactly what we'll uncover today. We'll start by understanding what dividend stocks are, move on to the criteria for selecting the best ones, analyze a couple of real-world examples, Archer Daniels, Midland, and Altria, and finally, compare different dividend investment strategies. Whether you're a seasoned investor or just starting, this video will provide you with valuable insights. So let's get started. This video is for educational purposes only and should not be considered financial advice. I am not your financial advisor and you are responsible for your own financial decisions. First, let's define dividend stocks. These are shares of companies that regularly distribute a portion of their earnings to shareholders. It's a way for companies to share their financial success with investors. Now let's define some key terms. First, dividend yield. Dividend yield is the percentage of a company's stock price that it pays out in dividends each year. It's a key indicator of how much cash flow you are getting for your investment. Payout ratio. Payout ratio tells us what proportion of the company's income is paid out as dividends. A lower payout ratio could mean the dividends are more sustainable. Dividend growth rate. This measures how much a company's dividend has grown over a period. Consistent growth often indicates a financially healthy company. Lastly, a company's financial health is crucial. Strong earnings, low debt, and a stable cash flow are important indicators that a company can sustain and grow its dividends. Now, let's talk about how to pick the best dividend stocks. It's not just about high yields. There are several factors to consider for long-term sustainability and growth. Look for companies with a history of stable and consistent dividend payments. This shows they have a track record of managing their finances well enough to reward shareholders regularly. Low payout ratios. A low payout ratio is key. It suggests the company isn't stretching its finances too thin and can maintain or increase dividends even if earnings fluctuate. Companies with steady revenue and profit growth are more likely to sustain and raise dividends. This is a sign of a healthy, growing business. Finally, consider the company's overall business model and its position in the industry. A strong competitive advantage often translates to financial stability and consequently a reliable dividend stream. In our exploration of dividend investing, we come across a unique group of companies known as the Dividend Aristocrats. These are companies that have consistently increased their dividends for at least 25 consecutive years. They're not just surviving, they're thriving and rewarding their shareholders. Today, we're focusing on Archer Daniels Midland Company, better known as ADM. ADM is a global leader in food processing and commodities trading. Let's dive into why ADM is a prominent dividend aristocrat. ADM operates in the agricultural industry, converting oilseeds, corn, wheat, and cocoa into products for food, animal feed, industrial, and energy uses. It's a critical player in the global food supply chain, boasting an extensive network of processing and transportation facilities. Financially, ADM has shown remarkable resilience with a diversified product portfolio and global footprint. With a diversified product portfolio and a global footprint, it has navigated market volatilities effectively. This stability is the cornerstone of its ability to maintain and grow its dividends. ADM's history of dividend growth is impressive. It has not just paid out but increased its dividends for more than 40 years. This is a statement to its consistent financial performance and commitment to its shareholders. With a current dividend yield of 2.6% and a low payout ratio of 24.3%, ADM offers an attractive proposition. The company's strategic investments in high-growth areas like plant-based proteins and nutrition bode well for its future earnings potential and consequently its ability to sustain dividend growth. ADM's position in a fundamental industry, combined with its strategic growth initiatives, makes it a standout dividend aristocrat. Its consistent dividend increases reflect not just past successes, but also confidence in its future growth trajectory. I don't currently own ADM, but I'm putting it on my watch list. Now, let's examine a high dividend yield stock. These stocks are appealing for their immediate income potential, but they often come with unique risk. Today, we're focusing on Altria Group, ticker symbol MO. It's known for its significant dividend yield, currently at 9.5%. And by the way, it also happens to be a dividend aristocrat. Altria is a giant in the tobacco industry, and it's often highlighted for its high dividend yield. Let's delve into what makes MO or Altria a standout in this category. Altria's primary business revolves around tobacco and its related products, a sector with its own set of challenges and opportunities. Despite societal shifts, they have maintained a strong market position. Financially, Altria has shown resilience with consistent cash flow, a factor crucial for sustaining high dividends. However, the tobacco industry faces regulatory risk that investors should consider. Altria offers a current dividend yield of 9.5%, making it an attractive choice for income-focused investors. However, assessing its payout ratio and revenue stability is key to understanding the sustainability of these dividends. Its current payout ratio is 77.6%, which is high. However, the industry's payout ratio is 84%. And Altria's cash flow is highly predictable. Therefore, MO's payout ratio is acceptable. Investors should weigh the regulatory risk and ethical considerations of investing in tobacco against the company's efforts to diversify into other areas, like e-cigarettes and cannabis. While Altria's high dividend yield is enticing, it's essential to balance the lure of the immediate income with the potential long-term risk. As always, diversification and due diligence are crucial. Personally, Altria is a core holding in my investment portfolio. Having looked at a Dividend Aristocrat in a high-yield stock, which happens to be a Dividend Aristocrat also, it's clear that dividend investing isn't a one-size-fits-all. Different strategies cater to different investment goals and risk tolerances. High-yield investing focuses on stocks with higher than average dividends, ideal for those seeking immediate income, but it often comes with higher risk and less potential for capital appreciation. Dividend growth investing, on the other hand, targets companies with a strong track record of increasing their dividends. It's more about long-term growth and compounding, with typically lower immediate yields but potentially higher overall results. Smart dividend investing often involves balancing these strategies. You might combine high-yield stocks for immediate income and dividend growth stocks for long-term wealth building. Regardless of your approach, diversification and risk management are key. Don't over-concentrate in one sector or company, no matter how attractive the dividends may seem. To summarize, dividend investing involves more than just chasing high yields. It's about understanding the financial health of the companies, their dividend history, and choosing a strategy that aligns with your investment goals. Investing in dividend stocks can be a rewarding journey if done wisely. Stay informed, stay diversified, and keep an eye on the long-term horizon. And remember to always be compounding. Thank you for watching. See you in the next video. Take care.